policy at the Wharton School at Penn, and co-director of the Wharton Risk Management Decision Processes Center. The research focuses on ways that society can better manage low probability, high consequence events related to natural hazards. So, of course, over the years, his work has become extremely interesting to me because I'm interested in disastrous events quite a bit. Howard is a fellow of the AAAS in the Society for Risk Analysis. He's been my colleague recently on two large-scale efforts. One, the IPCC's Fifth Assessment Report, where he was the coordinating lead author of Working Group 3's Chapter 2, which is Integrated Risk and Uncertainty Assessment of Climate Change Response and Policies. And for those of you who don't know how IPCC operates, just getting that chapter in there at all was a revolution. And so it's good. It gives kind of anchors IPCC better and better with what the needs of policymakers are. And at the same time, we've been working together on the New York City panel on climate change, which has been providing, to greater or lesser effect, advice to decision makers in New York City. We'll see if they actually listen to this.
That's the question.
It's always a key question. Howard is the go-to guy on insurance for people in the climate community. There's nobody else close. So today he's going to speak about the role of insurance in reducing losses from extreme events, the need for public-private partnerships. Please join me in welcoming Howard J. Bradley.
Well, thank you, Michael. It's really a pleasure to be here today and have a chance to share ideas with you. And I've been told, and I absolutely love the notion of having questions at the end, so I'm going to try to give us 15 minutes at the end for your comments and questions. But first of all, let me just sort of say it's really great to be here at Princeton. I really see a lot of synergies between a lot of the things that are going on here, both in the area that Michael is talking about, as well as in the behavioral side with Daniel Kahneman, who is retired now, but having set a tone for that. And as Michael indicated, there's a whole set of challenges in the climate change area that we're both working on with a number of others, and I see it as a real challenge to get us to move forward in taking steps prior to a disaster so that we are not going to suffer all the losses that occur afterwards. And that's going to be a theme of the meeting today. Just a word about my own background so you know where I'm coming from. I am an economist, and you can celebrate with me Angus Deaton's award today, getting the Nobel Prize in economics on his work on inequality and poverty, and I'll try to address some of those points as a part of my talk today on affordability being an important component in the context of natural hazards. But I'm often called an irrational economist, since I happen to have spent a lot of time working with people like Daniel Kahneman and Paul Slovic and others in terms of trying to understand how we behave, and there'll be a fair amount of discussion on that in this talk today. And so our center, our Risk Management and Decision Process Center, which is celebrating its 30th anniversary in next week actually, has been focused from day one on how we deal with low probability, high consequence events. And as Michael indicated, it's only recently that people have really been kind of concerned. We felt like we were a voice in the wilderness for a number of years, but we felt it was really important to focus on the challenges we deal with when you don't have a lot of data to help you make decisions. So that's going to be the basis for the theme today. Let me just give you an outline of where I'm going. I want to start off with the fact that we're in a new era of catastrophes and give you a little bit of data to highlight that point. Then talk a bit about intuitive and deliberative thinking for dealing with extreme events, and really building on the book that Daniel Kahneman wrote, which is based on 30 years of research in the psychology area, Thinking Fast and Slow. Then talk about some guiding principles for insurance, and then particularly focus on affordability and the challenges in getting people to take steps beforehand, but also how do we make this insurance affordable for those who are on the low income side, and then raise some challenges and questions for discussion. So, and let me just highlight a theme that you'll hear me say at various points of the talk, but put it up front. Insurance has to go back, in my view, and I think those of us others who we've been working with, to its 19th century roots. It really needs to actually highlight the importance of mitigation and taking protection before a disaster as a condition for insurance. And it hasn't done that in recent years. Some companies have done that, but the factory mutuals is the way that they behaved in the 19th century, and some of them still behave that way today. But that's where we're going. How do we really use the insurance vehicle as a policy tool for doing the kinds of things it should be doing, which is to reward people for taking protection before. I'll come back to that at various points in the talk. Okay, new era of catastrophe, as you can see. The data speaks for itself on this in the context of what's happened between 1980 and 2014. Here's some data just from the period from 1970 to 2014. And the points that you should focus on here is that 12 of the 15 most costly disasters occurred since 2000, the year 2000. You can see everything in red is after 2000. And most of them in the United States. The fact that most of the United States is not all that surprising, simply because of the fact that the developing countries have had lots of losses from disasters, as we're all aware of, but they don't have very much insurance. And so that's a challenge we're all focusing on today. How can insurance be part of their policy tools? And it's not all that easy to do. Okay, a few disasters to focus on. The Honshu earthquake, you can see, with 10,000 fatalities, 183 billion in damage. Sichuan earthquake, these are all in developing countries, well, Japan is developed, but you can see the damage. Hurricane Ivan is the one I always like to use, because when you look at the damage from Hurricane Ivan, that hit Grenada in the 1990s. It was 889 million, and that doesn't seem very much, but then if you put it in the context of its gross national product, then it's huge. And Hurricane Mitch in Honduras had a very similar kind of characteristics. Countries have an enormously hard time when you have these disasters. We all know about Hurricane Sandy, and of course this is the classic picture that we've all seen with respect to that. And there was $65 billion damage and 285 fatalities. And Hurricane Katrina, which I didn't put up there, there was more fatalities than any disaster we've had, and about 6,000 people lost their lives. And then I had to put up what we're currently facing right now, the flooding in South Carolina that is raising all sorts of questions with respect to how to deal with the flood hazard, and they're still struggling with this and will for a while in terms of what damage. And the damage at the moment is about over $1 billion, but it may go more than that. And not that many people have lost their lives. We sort of all have seen many of these what was on. Let me also make one point. I know this is a lecture, and I appreciate that. And if there's a clarifying question, if there's something that comes up, I hope that's, I don't know, I can set the tone for that by saying anyone can raise that if they'd like, but we'll have our discussion at the end with respect to that. But don't hesitate if there's something you feel is not clear, and you probably would be the audience in that situation. Well, what's happening about this? Why are we having these problems? Well, the big problem really is urbanization in these hazard-prone areas and a huge increase in value at risk. People really want to live in places that are very attractive, Florida being one of them, because of the wonderful climate and the beaches and whatnot. And they don't think about the hurricanes there, but they are severe. And what is coupled with that, as we all know, and that Michael alluded to, is climate change and weather patterns and sea level rise with changes in climate conditions. Sea level rise obviously being an amazing challenge in terms of adapting to the hazard, and then the mitigation part being on top of that, and then more intense weather-related events. And I will say, just for, Michael alluded to this, but I'm very excited about the NSF project that is really based here in Princeton, that Michael and others are involved in, simply because it really raises the issue of how do we bring the science together with the policy and dealing with this. And of course the issues with Hurricane Sandy here in New Jersey raise all these questions in a very, very meaningful way. So we'll see what happens. Will 2015 bring anything more than South Carolina? We're not quite sure yet. We're still in hurricane season, but we already know that that was at least partly caused by that. I don't want to say something about climate change because it's so important, and as Michael alluded to, there was the New York City Climate Change Panel, which we both were on. Michael as more in the climate science community, I was more in the policy side, learning from everyone on that panel in terms of how to deal with this. It was a fascinating experience, and what that really did was, it really provided some data that is worth at least reflecting on in terms of what could happen with sea level rise in the 2020s and 2050s. And middle range estimates run from 4 to 8 inches in the 20s and 11 to 24, and then there's obviously variability, and if you're real lucky on the low end, it will only be 7 inches, but it could be as high as 31 inches. That's enormous when you think about what that means for communities that are really at sea level, Miami and New Orleans being 2 examples of what's going to happen to this. A lot of others as well. And New York City isn't immune from that as well, and that's one of the reasons why why Mayor Bloomberg, having had these panels and the continuation of the work that's going on in New York, is of great interest and great importance. And I have to put this up because of Europe and the Greenland ice sheet. And I can't give an estimate on that. Others in the room can do this better than I can, Michael and others, in terms of what the likelihood of that melting. But if that happens, better visit London before that time. This could be a major problem for a good bit of Europe. If that. So we have these incredibly challenging issues, and the reason for putting this up, it's not going to happen tomorrow, but something like that could happen over a period of years. You want to, Michael, I won't push you very hard, but but this is an issue, right, that one has to think about 20 or 30 years from now?
Well, there's a gradual contribution from Greenland, a gradual contribution from Antarctica. This scenario is hundreds of years in the future.
Thank you. Okay, thank you. So I hadn't heard when that scenario would be. So relax.
Don't relax, because you can trigger it by our actions now.
Okay.
Don't relax too much.
All right. Well, but at least I won't say visit London 20. I mean, you can probably do it, but there are real challenges. Okay. So what questions am I going to address in this talk here? I'm going to focus on the National Flood Insurance Program, which is a national program for providing protection against floods. And we've been working in this program, many of us, for a number of years, but there are enormous opportunities to use this program to get the insurance industry to think creatively about how they want to protect their risk. And because it's a national program, insurers are very comfortable with a lot of the suggestions that we're making, even though they may not make it on their own policies that they're dealing with. But the questions are broad questions. How do homeowners residing in hazard-prone areas make decisions on whether to undertake protective measures prior to the next disaster? Second, what are 3 guiding principles for insurance to encourage loss prevention and affordability, the point that I was making earlier? And how can the program be modified to link insurance more closely to mitigation measures while addressing affordability issues? And insurance is only one part of the policy tools. You have land use regulation, you have building codes, you have just a large number of other policy tools that have to complement insurance in dealing with that. So that's where we're going to go, and let's get started with linking into it. So, how many people are familiar or have read Thinking Fast and Slow here? Okay, so we have a few of you. It's a really creative book. It's not easy reading, but it's important reading. And Kahneman has made this a very topic that people have to pay attention to and are paying attention to now in the ways they haven't before. It sold over 2 million copies, translated into a number of languages, and really has made an impact. And what Kahneman does in the book, which we'll do here, is simplify things in a way, but highlight the challenges we have. He talks about intuitive thinking, which is system 1 behavior, and intuitive thinking is what most of us do most of the time. We make simple associations. Emotion plays a key role. Past experience plays an enormously important role. And there are a set of systematic biases, I'll show a few of them in a moment, that people follow, and they use simplified decision rules. But here's the point that Kahneman makes and that I want to make here. For most of our decisions, intuitive decision-making really works well because we have a lot of past experience. We tend to be able to really understand the problem, and simplified rules makes it easy. We make hundreds of decisions every day, and have simplified rules is a way that we can survive and deal with things. And some of these biases are not necessarily unattractive, as you'll see in a moment. They get you to pay attention to things that you otherwise may not, and you can use the biases in a creative way. So we do very, very well with this. We do horribly with low probability, high consequence events. Horribly. Because of all the characteristics that we don't have. We don't have a lot of past experience. By definition, it's a low probability event, so the disaster isn't going to happen to me. Emotions play an enormously important role. Fear, dread, but not before the disaster, but afterwards. There are a set of biases that come into play that lead people to do a set of things, but they should have done beforehand, but don't do afterwards. And so everything about these really raises challenges, and that's what our Risk Center has been focusing on for the last 10 years. How do we deal with the intuitive decision-making and understand that, but recognize that there is deliberative decision-making that we would like to see people focus, and many people, even with these low probability events, will combine the two, the intuition with deliberative, but they got the wrong data, or they're using the very simplified decision rules to do it, and as a result, the decisions they make do not turn out to be very, very good ones. And so system 2, people undertake trade-offs and benefit cost analysis in order to be able to deal with this kind of stuff that I will teach in my risk analysis class. This is what one would like people to do. You recognize interdependencies and interconnectedness, and most important, there's a focus on long-term strategies to cope with extreme events. So here is the theme that one needs, that I'll put up for us to think about. How do we develop long-term strategies, doing some of this work on System 2, but have short-term incentives so people will pay attention now, where they're otherwise not going to pay attention. So that's the economist in me coming out and saying we need short-term incentives in order for people to actually take steps on long-term. It's combining the two because you've got to interact in some way. And just in passing, I should indicate that we have really Thinking Fast and Slow to thank for Chapter 2 on our risk and uncertainty. We had it in my climate change. It was a fascinating experience. Michael's been involved a lot more than I have, but this was really my first opportunity to really get involved with the Intergovernmental Panel on Climate Change. And we had a group of people in that chapter, some of whom are all on the deliberative side. They were thinking about decision analysis and how you deal with extreme events with probability estimates, all the things you would do. Then people like Roger Cook, who some of you may know, and others who really saw the world that way. And then we had other people on the committee, like Elke Weber and Tony Pat, who really were behavioral ones. And Elke and I got very close over these 4 years because we knew each other beforehand. But we sort of said, how do we get this group to come together? And I said, Elke, why don't we use Thinking Fast and Slow? Why don't we use intuitive and deliberative? And that's what our chapter is about. It really highlights the risk perception and the behavioral side on the intuitive side and all these. And then it says you got to do some deliberative. You got to use decision analysis. You got to have scientific data on cost benefit. And the question is, how do you bring the two together on policy? So in the spirit of what Michael indicated in IPCC, I found it a fascinating experience in the sense that it forced me personally, and all of us, I think, on the thing to think about, how do we bring these two together? And that's what I think our challenge is right now. Behavior and trigger. Let me go through a few of these biases. There's an availability bias that many of you may know, which is that you think about an event only after it occurs. It's very salient then. So you don't buy earthquake insurance before the earthquake, but you're really happy to buy it afterwards, even though when you ask the question, what's the likelihood of another earthquake, you're going to say it's lower than it was before. So you aren't doing Bayesian analysis in any way, shape, or form. And so that's a challenge. People use that. Threshold models, just the opposite before a disaster. Fail to take protective measures if the likelihood is below a threshold level of concern. So I'm not going to think about it. It's so low, I'm not going to worry about it because it's sufficiently low. Imperfect information. You may misperceive the risk and not necessarily think about its probability as being as high as it actually is. And the one that I think is most important, what we're talking about here, is myopia. We focus on short-term horizons. And when we compare mitigation or adaptation, I'll use adaptation in the climate change sense, making your house safer, making your facility safer, there's a high upfront cost, but if you're going to only think about the benefits for the next 2 or 3 years, you're going to say, I'm not going to do it, because the cost is so high relative to those benefits, but those are long-term benefits. It's for the life of the structure. You're doing that once, and the upfront cost discourages a lot of people from taking that step, so we have to address that issue. And if you think you're going to move or other things, then there may be rationality to doing that, even on a deliberative side, if you don't think the property value will actually reflect that. So these are a few of the biases. So I'm going to use one example to take us through this as we go, look at the challenges. Here's our family in the Rockaways, the Lowland family. They're considering whether to invest $1,500 in floodproofs in their house, so it's less susceptible to water damage. Hydrologists have estimated a 1 in 100 chance that if it occurs, the savings from floodproofing will be $27,500. So this will be a safer house by virtue of their doing it. And here's the point that we're going to come back to in a few minutes. If premiums reflect risk, which they should, that's what insurance is about. If a premium reflects risk, and I'm just going to give you the actuarial, I'm not going to put on any loading cost or administrative cost. If premium reflects risk, you will save $275 on your insurance premium because there's a 1 in 100 chance next year of that flood occurring, and your savings will be $27,500. You multiply the two and you get the savings. Now, if it turns out they're loading costs, you'll even save more if they're administrative costs because the premium will even be higher and your reduction will be higher. So that's the example we'll come back to with respect to that. So how did the Lowland family respond to Hurricane Sandy? They misperceived the risk. It's 1 in 1,000 rather than 1 in 100. It's below my threshold level of concern. I didn't take the protective measures because I didn't consider the long-term benefits. And this is true, I'll show in a minute some data, we canceled our flood insurance, which we bought after the disaster, because we haven't had a loss in the last few years. And so we're saying this is a very poor investment, and as a result, we're not going to continue our insurance. We'll look at all the things we could have done with our premiums if we hadn't bought that policy. Yeah. Clarification? Yes. And please introduce yourself, Jim.
My name is Mike Trachtenberg. I teach sustainability at Rutgers, and I did lots of risk analysis for NASA.
Okay.
So this is great. But there seems to be a separation here I don't quite understand. If you're taking out a loan for the property,
they haven't taken out a loan yet. Remember, no loans have been introduced yet. I just want you to know that. I will talk about loans in a few minutes. Right now, they have a cost of X thousand dollars that they have to. So I will come back to that.
Please explain the distinction between mandated insurance by the loan provider and voluntary insurance components by the homeowner, and why they should be separated.
Okay, well that's a great question, and let me answer it this way. And I'll show you some data. Flood insurance is required as a condition for a federally insured loan, but a lot of people don't have it, and banks haven't enforced it. That's number one. Homeowners insurance is required as a condition for a mortgage, and that almost everyone has that, and that's well enforced. But with flood, it's not. But there are an awful lot of people in these areas who don't have a mortgage, who are low-income people. They may have inherited the house. There are a lot of other things that are going on. So the coupling of loans by banks is a critical thing that you'd like to see, but it doesn't always work as well as it could, and I will come back to that. I will address it, and then if there's an additional question afterwards, I would be happy to do it. But I will come back to just the points that you're raising. So it's an appropriate one, and and here you are. Here's the next point. They don't enforce the flood insurance requirements, and many states don't enforce the building codes. Florida is a great example of that. 1/3 of the damage from Hurricane Andrew that occurred in 1992 could have been avoided had the state enforced its building codes. But here's the interesting point. The state did learn from its past experience. It has the best enforced building codes in the country today because of that. And so it took the disaster of Hurricane Andrew for them to recognize that they had better do things in a different way. Okay, lack of insurance protection. And this really relates to your question. Many homeowners cancel their policy. They see it's not a good investment. Here's some anecdotal data by the Federal Emergency Management Agency from a flood that occurred in Vermont in 1998. 84% of the residents in special flood hazard areas didn't have flood insurance. 45% were required to purchase it. And here's the data that relates directly to what we're talking about. We have the entire flood insurance database from FEMA at our risk center, and I've analyzed that data. My colleague Aaron Michelle Kirchhoff has taken a lead on that work. And what you can see is that here, I'll just look at 1970, 2001, and 73% of the people who bought it still had it a year later. You go down to 3 years, only 39% of them, and way down to 8 years, only 20%. Now, it is true that some people have moved, and I want to make that clear, that there is some, and that would account for part of this, but not to the level that we have here, and not to the extent of the percentages that went down. The average length of time in the house is 5 to 7 years, and many of these people have been there a lot longer, and they don't have a policy. So how do we aid decision-making, deliberative thinking? That's a theme of what we want to do. How do we do a better job? Well, one thing we have struggled with, and we still have not gotten a good answer, is for the insurance industry or someone to be able to tell people the best return on your insurance policy is no return at all. Celebrate you didn't have a loss. Celebrate you were protected against that. But people don't see it that way. They all say, look, I wasted these premiums for 5 years, and look at what I could have done. I could have taken a nice vacation, could have done a very thing. So that message on how we do that, very hard to do. So what we're saying is use the availability bias to focus on that. Highlight the financial problems. Focus on the consequences, not the probability, and show them what could happen if their property was destroyed and unprotected and uninsured. So that's a way to do it. And then something that I've actually done a little experiment here in Princeton to tell you. I used to teach, I taught when Danny Kahneman was teaching a policy class with Ella Shafir. I was here to give a guest lecture, and I had half the class who was asked the question, what would you pay for insurance if you had a $30,000 loss and there was a 100, you're protecting yourself, $30,000 loss, there was a 1 in 100 chance to actually suffer that loss next year. And then the other half had a 1 in 5 chance of experiencing at least one flood during this period, but you're buying insurance for next year. And just focusing on 1 in 5, just that figure, even though they knew it was just next year, but giving them a 25-year horizon, people were willing to pay 3 to 4 times the amount for insurance just by seeing 1 in 5. It was a little, it's one of these things. And I'm not saying I wouldn't have made, we all tend to make that mistake. We focus on that and forgot that, who knows all the reasons. But giving a 1 in 5 to say, I better pay attention to that if I think about it over 25. So stretch the time horizon as a part of that. Okay, so let me move on to guiding principles for insurance and how that plays a role, and what insurance should do, and then talk a little bit about a program that addresses some of the issues we were talking about with loans being an important component of that. So the guiding principles of insurance, I've already reflected on this. Principle 1, premiums should reflect risk. There are 2 reasons for that. 1, it signals to people the hazard that they face. If you have a highly subsidized premium, you're going to think you're safe. If you say, I'm only paying $100 for my flood insurance policy, and you say, well, gee, I guess I don't have much of a risk, where the true risk might be $1,000 or premium, a much higher risk. So, but the other part is it encourages investments in mitigation or adaptation measures. And the reason for that is that if you have a subsidized premium, something that is really low, no insurer wants to insure you. Why is that? What? Truth. Yeah, and what's going to happen to them? Right, they're going to lose a lot of money in the process. Exactly. So if they don't have a premium reflecting risk, the National Flood Insurance Program has done that. But they're a government program, and they did it to keep property values high, but no insurance would ever do it, and the flood insurance program shouldn't do it, is the point that we're making. It should not have premiums that are subsidized, because it doesn't do anything to make people aware and encourage people. Second principle is the issue that Dinan is concerned about in his work and that we're concerned about is how do you deal with equity and affordability. And the reason we have that principle is that, first of all, we think it's important, and second of all, politically, you're not going to make any headway at all unless you deal with that issue. Because if it turns out that you're not going to help the low-income people, you're going to have problems, and I'll show that in a moment in terms of what's happened to legislation with the flood program. So you provide vouchers. So we're suggesting don't do it through an insurance premium. Do it through vouchers, like food stamps. Do it through something that actually helps people, but it requires them to buy insurance. They can't use a voucher for anything else but insurance. And the second part that we have, and this is work with Carolyn Kuski on this, is only provide a voucher if the homeowner mitigates their property. So it's a carrot and stick idea that you're trying to say, look, we'll help you out, and we'll help you out with affordability, but you got to do something. Make your house safer. Go back to the notion that you'll get insurance and you'll get a voucher, but you got to do something. In this case, a voucher to do that. And principle number 3 that we've been struggling with for many years and haven't been very successful, although there's now a little bit of interest, is move away from single-year contracts. Have multi-year insurance contracts, which we don't have in the property side. And premiums reflecting risk. We address myopia in terms of people not canceling their policy. And we can have a loan to highlight mitigation and spread the cost over time so that this becomes attractive, and I'll show that in just a moment. So those are our 3 principles. Let me pause here just for a second, for a minute or two or whatever. Any clarifying questions, anything that anyone wants to raise on that? Yes, please, and introduce yourself.
My name is Juan Reyes, and I have 2 clarificatory questions. Number 1, my understanding is that certain disasters which are considered acts of God cannot covered by insurance. My second question is, how do you qualify an event as an act of God?
How do I qualify an act of God event, Judy?
Yes,
Well, I mean, that's an insurance question as well. And the insurer has to make a decision whether or not they're going to protect themselves and provide coverage for that. So the insurers have said many years ago, we were not going to provide flood insurance because they had a very large loss in 1927. And they say anything that is caused by water damage from a hurricane, we don't cover. So they are defining the insurance in a way that says this is not part of our protection. They do not provide coverage against earthquake now in California for the same reason. It's not because it is an act of God, it's simply because they say we are going to have such large losses that it won't be worth our while to do that. So that's it's really the insurer's decision on what they're going to cover, and that's kind of how it gets defined.
What about 9/11?
What?
9/11.
I'm sorry, I didn't...
What about 9/11?
Oh, 9/11, they covered it.
They covered it.
Yes, they covered it. And then after 9/11, they said, we will not continue to cover it. It's a perfect example of the since you're asking me, it's a perfect example of the availability bias. Before 9/11, they did not charge a penny for terrorism coverage. Not a single insurer charged a penny. They didn't separate it out. And they said, this is something that we're not worried about. Very surprising. Because of the 1993 World Trade Center abortive attempt that there was damage at Oklahoma City and terrorism around the world. After 9/11, they said uninsurable. We're not going to actually provide any coverage. One extreme to the other, and they focused on that. Yes.
A brief question. One, so it seems to me that the election following 27 and flood, et cetera, if there are examples, is a failure, an inherent failure of the free market that then invites a political market that has all the problems you alluded to. Number 1. Number 2 is when you're providing vouchers, et cetera, and making requirements, this opens the system to gaming at a very, very easily.
Okay, excellent points. I like the points, but I'm not going to respond to them now, and I'll tell you why I'm not responding, because I'm going to go through precisely a set of slides now, and I want to end in the next 10 minutes. So people can then have an opportunity. So, and they will address that point, and then we can come back. But you've set it up in exactly the way that I would want to see it set up. That the theme of this talk is public-private partnerships. You do need the public sector involved for a whole set of reasons. The question is, what can they do in a manner that will help the private market function? And I have to make the appropriate disclaimer, you know that. I am at the Wharton School. I'm at the University of Pennsylvania, Wharton. And so I'd like the free market to operate as best as it possibly can. That's where we want to go. But in these areas, it's not working, and we have to figure out what is a better system. So let me come back to that question in a few minutes. So here are some insurance voucher examples. I already mentioned the food stamp program, low-income energy assistance program, universal service fund. They do exist, these programs, particularly food stamps, which has come under some attack, as we know, but they are ones that at least could partially set a model. Okay, now I'm going to go through this. You've set the Lowland example to highlight how one might deal with the Lowland family with all of its biases so that they can make a better decision about proofing their house. Here's the data that you saw a few minutes ago, the $275 with respect to what the benefits are. And here's the benefit cost analysis that we would do to show that. If we look at a discount rate, and I have a high discount rate of 10%, the expected benefits to cover the $1,500 cost would take about 8 years to do that. But this is attractive. The benefits are, the discounted benefits of $2,500. You have a lower discount rate, you're going to get even greater benefits of that. If you had over 30 years, you're saving $1,500, you'd be saving a huge amount of money as a result of that. With a lower discount rate. So this is attractive. That's the only point I want to make. This is an attractive investment for the length of life of the house. It's highly unattractive if you're myopic, because after 2 years you're going to say these benefits are a lot lower than the cost. So why do I want to do that? And the answer is they won't. But we can highlight this in the following way. We can basically say, look, we'll give you a loan for 20 years tied to your property. The annual, with a 10% interest rate, it's $145 is the cost of the loan. It'll be less if it's a lower interest rate, and you're going to save $275. So this is really attractive just financially. I save $275 every year on my premium. I only have to pay $145 for my loan. So as a result, I have $130 windfall every year that I have it because I've stretched the time horizon. So that's a way to deal with it. It's not the only way, but it is a way to deal with it. Okay, let's talk a little bit about the insurance voucher program and the notion of how that would play out. The most revolutionary piece of legislation in our minds that passed in 2012, 3 months before Hurricane Sandy, was the Biggert Waters Act. We have no idea how it got through Congress. It was put into a transportation bill. The Tea Party people wanted this because it was such a debt in the flood program. And everyone wanted, and I think others would have wanted this because they did highlight affordability as an important component here. So it had the two principles we're talking about. The National Academy of Sciences was supposed to do a study on affordability right after this bill was passed. They didn't get started and didn't get funded by FEMA for a year and a half, and Hurricane Sandy came in between, and as a result of that, this bill came under a lot of pressure and was rescinded. The Federal Emergency Management was supposed to draft the framework based on the study. They finally funded the study, but it only was funded in January of 2014. For full disclosure, I'm on the NRC committee that is looking at this, but the damage had been done. There was so much concern with respect to not only Hurricane Sandy, this was a year and 3 months after Sandy, but also Katrina. There were people who were running for re-election in 2014. They said, I will not get reelected if I don't push affordability as a key part. Senator Landrieu being a prime mover from Louisiana. There's a little acronym that I'll throw out. Some of you may have heard, but if you haven't heard it, you can take a guess. NIMTOF. Anyone? Not in my term of office. Well, I can avoid it, and that's basically what happened here. We had a new piece of legislation passed in March 2014 that rescinded the risk-based or postponed the risk-based premiums. They recognized the concerns of affordability by Sandy and whatnot. They delayed the principle of insurance premiums to reflect the risk, and that's basically where that study came about. I had that slide here. when I saw that. So that's basically what happened. So you know all of this because I've already talked about it. So I can basically say, here's the strategy: risk-based premiums, home improvement loans, premium reductions for undertaking mitigation, affordability, means-tested vouchers, covers both the premium and the mitigation loan. Condition for a voucher: you must mitigate. Require multi-year insurance. That's what we'd love to see on this, and loans tied to the property. Okay. In the interest of time, and these slides I can certainly make them available, and there are papers that will do this. Let me go through very quickly the little project that we did with Ocean County, New Jersey, getting data from Ocean County to highlight how something like this would work. And basically we did 2 families. I won't go through all of the details except to indicate families in the A zone. Their insurance premium was $4,000. That's a less hazardous zone than the V zone, the high velocity zone, where the premium would have been $18,550. These are just 2 representative homes. We put them 3 feet below flood elevation. We gave each of them a $50,000 income per year to illustrate this. So to look at this as an illustrative example. The cost of elevating the home for family 1, the data that we were given was about $25,000. With a 3% loan, you could get a payment of $1,680. Family 2, $55,000 and their loan would be $3,660. Means tested vouchers. All we did was to say, look, we're going to take a certain percentage of the income to say how much could they afford for mitigating and insurance, and we looked at 5% as the value. So we said anything over $2,500, they get a voucher to cover it. But it has to cover both the loan, the insurance, as well as the mitigation measure, and the loan will be part of what we'll cover. We wanted to see how that would differ from the original proposals that we and others had made, that you cover just the insurance cost without the mitigation tied to it. And that's where we started off. So here's the data. The data speak for themselves. If you just have the loan covering the voucher covering the insurance cost for the V zone person, you can see essentially how much you have to give that family. It goes way down if it turns out you tie it to the loan and that they have to do both, assuming they can do that, and that has to be an assumption. And after 20 years, the loan is paid off, it's even lower. What's interesting in the case of the house in the A zone is if you give them a loan and they don't even need a voucher, because the amount they're going to pay, their insurance premium goes so way down that they don't need anything at all in terms of being able to somehow deal with this situation, where they would have had to get something if it was just an insurance voucher. So when you take this for all of Ocean County, here's the savings to the federal government, who would be having to pay for the voucher. With an insurance voucher alone, they have to pay this much. With a loan and insurance, it would be this much for the first 20 years and that much. So that's a rationale, at least, to think about this as a way of dealing with this. Everyone's a winner here, in our view. It's my favorite little icon here, winner. We are all winners. It hasn't happened, but the homeowner, lower payments, the National Flood Program, reduction in flood losses, financial institutions, a more secure investment, which is why you want to require the insurance as a part of it. Federal government, lower voucher costs due to reduced insurance premiums, and the general taxpayer, all of us, a lot less disaster assistance. So that's where we are. Challenges, I'll go through very briefly. The long-term challenges: how do we get long-term strategies for dealing with this? Deliberative thinking. What are the short-term incentives for encouraging this behavior? How do we develop a risk management strategy that recognizes the importance of equity and affordability? A lot of future research. You've already heard about work on behavioral side. How do we stretch time horizons? How do we make people whole in a sense? How do we highlight the expected benefits of loss reduction measures to the key interested parties? How do we tie loans and insurance to property, not to the individual, so that they don't cancel, keep it? You can do that with the flood program because there's only one insurer for residential structures. So you can do that with property in a way you couldn't do it with a normal policy. What's multi-year insurance and how do they play a role? And finally, long-term issues. How long is it going to take to do better maps? That's the NSF project that we're involved in now. FEMA needs to work with the private sector and people here at Princeton and others to do better hazard maps that more accurately reflect the risk. Otherwise, how can you set a risk-based premium? Second, how costly will affordability programs be to the public sector and residents? The short-term challenges: how can we restore the best features of Biggert Waters? How can the impacts of climate change be incorporated in flood insurance to encourage investment and adaptation measures, tell people sea level rise and see what happens? And what are the most appropriate ways of dealing with affordability? So that's what this is all about. Conclusions: insurance can spread the risk. I hope that's clear. If we don't see that, then insurance does, you pay a small premium to avoid a large loss. And it potentially offers incentives to mitigate. The National Flood Insurance Program faces challenging questions with respect to implementing mitigation measures and addressing affordability issues. They've got to change. We need to encourage deliberative thinking by focusing on the long term, while providing short-term incentives for acting now rather than waiting by assuming it will not happen today. So, to end, 3 little slides. This is my favorite slide. I have Larry Larson to thank for that. I'm dealing with flood. Jerry looked at the flood insurance and said, it is too damn expensive. So this is a way to deal with it, not necessarily the ideal way. And the dog is safe too, I see. So that's it. Here's a book that the National Research Council put out on disaster resiliency, a national imperative, which I highly recommend people look at because it does give a strategy, a long-term strategy. The National Climate Change Assessment Report highlights a lot of the issues here that we face with climate change and complements the IPCC report that Michael was mentioning earlier. And I will mention a book for those of you who are interested in insurance or want to learn a little more. My colleague Mark Pauly and I, with Stacey McMurrow, did a book that took us a few years to write. I'm looking at health and property insurance, some of the common features. And we decided to entitle our Insurance and Behavioral Economics with the subtitle, Improving Decisions in the Most Misunderstood Age. So on that note, let me conclude and turn this back to Michael.
Start off by asking you maybe a too complicated question, but you mentioned at a couple of points where institutional failures. The insurance companies act like individuals in the sense of having the availability heuristic, using the availability heuristic. They do nothing about a rational rating and then dismiss the whole field basically after a big hurricane. Poof, we're not going to cover flood insurance. The banks don't do their job by enforcing the flood insurance provisions in mortgages. Mm-hmm. And you started by saying that the industry had it right 150 years ago, essentially by insuring against risk, and then gave up the part of worrying about people doing things in advance, mitigation. Oh, is the problem a political one? Because this wound up being a highly regulated industry and they became very vulnerable to political preferences. What went on? Because this is all great, but if the problem is bigger than being rational, how are we going to fix it?
Yeah, no, it's a great, well, I'll answer it on a couple different levels, Michael. The first